We had some big names reporting earnings. So it's a bunch of good stuff happening in the markets right now, right? But the thing is, as an investor, you got to understand where the dollar is flowing in order so you can know where to get your dollar going in order to get that dollar growing, right? So as it stands right now, it's definitely still bright spots in the fixed income side of things, right? It's definitely bright spots in the debt markets, right? Investing in whether it's going to be high yield savings accounts, CDs, different online brokerages, money market accounts, and things like that. Shorter term bonds. That's where a lot of the money is flowing right now. It's into those shorter duration, higher interest credit. I'm gonna say liquid money products, right? Like I said, the CDs, the interest, the bonds, the money market accounts, things like that, right? Where you don't have to tie your money up for too long, but you still can take advantage of that extremely high interest rate right now. Because of course the name of the game is to get that locked in, right? Because the banks are going to agree to whatever fixed interest rate that you guys, that they're promoting, or whatever the case may be, whenever interest rates go up and down. And here's the thing, right now, some banks are even reducing, right? They're even reducing the APYs that they're paying. They're reducing some of the yields that they're paying in light of the Federal Reserve supposed to be pivoting and becoming more dovish and lowering of interest rates, right? And you gotta think about it. They're not even at that point of where the interest rates have started to decrease, and banks are already getting ahead of that, right? Ensuring that they're able to protect their dollar. What the banks are doing, they're protecting their profitability, because guess what? As debt becomes cheaper, they're gonna make less on the money that they're lending, right? So, and they're gonna maximize their profitability in the here and now before the Federal Reserve lowers the interest rate. So they're gonna be paying a lower interest rate, a lower APY to the people that are depositing their money with them, and they're going to be essentially retaining all the excess, right, the access, and they're going to be keeping that for themselves, going as they get ready for the what's to come, right, as they get ready for the pivot of the Federal Reserve. So basically, you want to take advantage of this, right, whether you're investing in ETFs that track the debt market, or whether you're physically investing in, let's say, 7-month or 1 year or 2 year CDs, or things like that, right? Or even more liquid accounts such as brokerages, or different online accounts that can play you up and give you some good rates on that. So right now, the focus is on the yields on bonds coming down, right? That's the focus right now, is the fact that the yields on bonds coming down. And what that means is, for an investor, you got to understand, when the yields on shorter duration bonds increase, is typically when interest rates increase, because those rates are tied to the interest rate of the Fed rate, right? The interest rate that the Federal Reserve sets is closely tied to the interest rates that are given when it comes to the APYs that you're going to receive and things like that. So you got to understand that if yields are starting to come down, it's just an indication of what's to come. And here's the thing, because stocks tend to perform very well during low interest rate environments, right? Shorter duration bonds tend to do well during high interest rate environments. And this is just what's known as when different economic cycles occur and the economy shifts and goes in different directions, from a tightening versus an easing, or easing versus a tightening. This is just understanding where the money is rotating, where the money is going, where the money is flowing, right? And that's going to be one of those things. So higher interest rate environments, guess what happens? Businesses tend to lay off a lot of employees. People tend to lose a lot of jobs. There's less liquidity in the economy. And it's just overall, the landscape is set for a slowing or a retraction, or a bust cycle, if you will, a downturn, when it comes to the ability to, I'm gonna say, pull some of that liquidity out of the economy, right? Because you got to understand, the reason why interest rates had to get hiked in the first place is due to an overstimulated economy. which is about to start happening right now. So that's what the battle is. That's the battle that we're facing right now is, well, is there going to be a hard landing versus soft landing? Or is the economy going to go into a recession and collapse, or is it going to go into, is it going to be an inflationary environment? Because of course, stimulating the economy, adding liquidity, adding being able to create debt for cheaper is going to be a good way to entice consumer spending, entice consumer borrowing, entice borrowing from corporations and businesses of the like. So you got to understand as an investor what this means. This means that stocks are going to perform well. Certain stocks are going to perform better than others, right? Because with increased liquidity, with increased spending, this means that businesses will have increased profitability, as we all know. And when this happens, guess what? You as an investor have to be able to ensure that you're able to get the most bang from your buck. You have to ensure that wherever you're putting your investment dollars is going to be able to work as hard as it possibly can for you in order to ensure that you get a safe and practical, profitable return. That's going to be the name of the game. And typically, after a downturn, if you think about it, when the Fed reduces the interest rate, what will happen is going to be more liquidity. More liquidity means more dollars that can be put into the stock market, right? So there's going to be more investment power, just like there's going to be more purchasing power, there'll be more investing power. So this typically pushes the prices of stocks up, as well as different economic data like jobs report, payroll report, consumer price index, and things like that, earnings season, and different guidances, different forward guidance. I'm gonna say, you know, the overall sentiments from investors is going to be fair. It's always fairly positive when there's more money. The more money that there is in the economy, the more money that businesses stand to make, and then of course the more investment dollars that you stand to make. But here's the thing: you got to get ahead of the curve, because right now, typically during higher interest rate environments, the companies that fare poorly are going to be tech. This is only because most tech companies rely on debt very heavily in order to grow. A lot of tech companies use debt to grow in a massive way, and then of course, it's a lot of the interest rates on this debt is typically variable. So you got to think about it. Whenever interest rates go up, right? Whenever interest rates go up in the economy, and that means the debt that they're financing costs them more. And this is often why, because a lot of tech sector, a lot of companies in the tech sector, they typically will, their goal is to ramp up production, to stay disruptive, to stay innovative, and to build as quickly and scale as fast as they possibly can. So they oftentimes take on a lot of debt, and they will expand to the degree in which they're able to really push and scale and grow revenues and earnings in an expedited manner, right? Now, here's the thing. When debt becomes expensive, guess what happens? Now they're going to start to lay off staff, right? Now they're going to look to decrease overhead in order to sustain certain levels of profitability and sustain their margins and sustain their earnings, their revenue, their profits, and free cash flows and things like that, right? So this is the name of the game. So typically tech tends to do well, do badly, I'm going to say, with a stock at least. I'll say the stock. Because some companies still expand, some companies still have the ability to grow and things like that. But I will say that the stock tends to fare poorly during high interest rate environments. Financials, even though they tend to see the most increase during higher interest rate environments, they tend to see, because they make more money because they're able to sell debt. Essentially, is what they're doing, selling debt, selling more expensive forms of debt is what they're able to do. So then they make more. If you got to think about it, if people are still taking out auto loans, because guess what? Even though the prices of automobiles have gone down over the last year to like record lows, the sales have increased to record highs year over year. Used cars is up 9%. Used car sales are up 9%, and new car sales are up 2% year over year. Now the prices of these vehicles are down, but guess what? The sales are up. So they're selling more units for a lower price, but guess what? The debt is higher, right? So if you're financing the debt, they're making more money. So they're moving more units that are being financed at higher interest rates. So now they're able to capitalize on this. So now financials, of course, doing fairly well in regards to that. I mean, the debt on credit cards, people still take out credit cards, people still take out regular loans, people still take out mortgages and things like that, just at a higher interest rate. So of course, financials typically fare very well, but their stocks tend to do poorly during these times. Small caps and medium caps tend to do, they tend to sometimes even go under, because depending on where they are in their growth cycle, mids and smalls, they might be financing a lot of debt. They might have to, so for them, the environment or landscape of cutting overhead, cutting cost, or even reducing staff, whatever the case may be, for a company in the growth phase, is typically felt a lot. They're feeling the squeeze a whole lot more, right, in terms of keeping themselves afloat. But here's the thing though, a lot of mid caps and small caps, if they survive these downturns where it's not as easy to grow, if they're able to still maintain some level of comfortability, they're still able to maintain some levels of profitability and growth during these times, they tend to get what's known as tailwinds that essentially propel and push their business forward when the economy is more favorable, which is typically during lower interest rate environments. So you can expect small and mid cap stocks to do fairly well during this next cycle. You can expect the more cyclical businesses, like some of the REITs, some of the automotive industries, entertainment industries, right? Restaurants, things like that. You can expect more people that make clothes and shoes manufacturers. You can expect more production coming from those areas coming up here in the near future. If you are watching this video, please, I encourage you to share this with anyone that needs to hear a good word, that wants to learn how to play this game and how to maneuver in these markets. That's what I make these videos for. That's why I moved my podcast to this platform right here, just so I can be able to help anyone that is looking for an avenue that they can become more efficient in, to just build that investor acumen and just learn how to play this game. And this is these little methods of like knowing where to place your dollar at, knowing where the money is flowing and things like that. Just understanding those little nuances is what separates the intelligent and savvy investor from the would-be investor and the person who's just looking to come, even if you want to say get rich quick, or if you want to say someone who's just looking to speculate or gamble with their money, not learning to actually play the game. That's the difference between losing money and not understanding why you're continuing to lose versus continually becoming more profitable over the years, just learning where to put your money and learning what happens when interest rates go up versus when interest rate goes down, and how favorable it is for the stock market, right, and things like that. So now you know where the buying opportunities are. So like, just getting back to it, so tech is a good place to put. Well, tech is a little overvalued right now, but they tend to fare well when the economy flips and we go into a more easing or a more liquid or more inflationary style economy. Economic factors right now. So when interest rates are lowered and debt becomes more readily accessible, or cheaper, I should say, to finance, then you'll get you'll get more people that use debt to do things, whether it is going to be to increase their liabilities or to scale their business. Either way, you're going to get it's going to be inflationary, right? So this creates booms and busts when you have periods of, I'm going to say, cooling inflation or easing inflation, and that's what the Federal Reserve is trying to combat right now. They're trying to combat the economy tanking versus enticing more inflationary pressures, right? And then when that happens, then now you gotta just understand what's going to happen as a result of what's happening anyway, like higher interest rates, right? What happens as a result of higher interest rates is going to be growth is going to slow on a the gross domestic product on that spectrum. Growth is gonna slow. But here's the thing though, whenever it gets to the point of growth being slow to where it's deemed acceptable, paired with optimal levels of employment versus unemployment, right? They want to have they want employment and unemployment to be sustained at certain levels. So here's the thing: as debt becomes cheaper, as interest rates go down, you're gonna see more jobs being created, and then of course, as more jobs are created, because more debt is being able to be used to finance. Hey, peace, JoJo. Debt is going to be able to. I appreciate that too, because debt is going to be able to use to promote and leverage that growth and scale that growth. So now you're going to be able to see more jobs created, which is going to be more money being made, which is going to be more people spending, which is going to cause inflation. That's how it works. So if you know how to climb that ladder of inflation, right, in the inflationary and deflationary ladder, you understand that what's happening is that stocks are going to be seeing an increase over time. Stocks do very well during low inflationary and low interest rate environments. Stocks just tend to do well because it's increased spending. You have people that are because you got to think about it. People have been experiencing that tightness for about the last year and a half, to where you have to be more keen with where you're going to put your discretionary dollar. You have to be more agile in your spending and your consumer spending, and then now you get some reprieve as interest rates come down, as liquidity is funneled and flooded and flushed back into the economy. Now you're going to be able to see. Now you're going to see more stimulation in consumerism, and you're going to see more growth being had with the business side of things as well. So this is just you understand what's happening, and you have to know how to position yourself, right? Whether it's going to be commodities, which are still pushing up. Gold is pushing up near record highs. Oil is, of course, going back up. You have silver and things like that pushing up. You got to understand right now, commodities it's a good time to be investing in commodities. It's a good time to be, like right now, financials are, compared to their earnings, financials are undervalued. Tech is overvalued compared to earnings. I wouldn't look for investment opportunity. I'm not saying you can't make money in these places, because of course they're going to continue to push up as the economic environment becomes more favorable for them. And I'm talking about increasing your profitability, increasing your ability to generate massive profits. You don't want to go into an area of the market that's already oversaturated, overstimulated, and inflated. You want to go to an area of the markets where it's going to be depressed, where it's going to be a little beat up, where prices are low relative to earnings, right? Relative to price to earnings, relative to price to book, relative to price to sales ratios, in comparison with 52-week highs and all-time highs and things like that. You want to ensure that you're able to get the most bang for your buck and still buy undervalued stocks of wonderful businesses that are set to do even better and get a catapult from that tailwind that's about to come with the lower interest rate environments, right? So financials is a great place to position. Even though the stock prices have been, for them, going up just like the other areas of the markets, it's just that their earnings have been increasing dually with that, which allows for them to be relatively still undervalued, right? Automotives, you can look for them to do well, just because their only issue is going to be price stability, right? Because they have been having to lower prices on vehicles just because the financing, the debt is more expensive, so they had to find a way to offset that. So let's decrease the price, right? We're gonna decrease the price in order to increase demand, okay? Because of course they don't want it to be a drop in supply. Well, they have the supply and they don't want a drop in demand. So the only way to stimulate that demand is by way of dropping prices for cars, because of course they're gonna pay for it on the back end with the higher interest rates. Okay, that's how that works. Like I said, entertainment is a good way to go. Whether it's amusement parks, whether it is movie theaters, whether it is things like that. That's a good place to position yourself in the markets. Um, let's see, another good spot is, like I said, places that like clothes manufacturers, shoe manufacturers, things like that. If there's more liquidity in the economy, guess what people can do? They can buy more goods and services. They can companies like Apple, people that sell hardware, people that sell things like that. You might, because you got to think about it, the sales, Apple's revenue and sales have been down. When it comes to like since 2014, this is like the biggest drop off in revenue they've seen on a year over year basis. Just because it's not because the products aren't, um, the products aren't falling off a cliff. The business isn't falling off a cliff. The business is actually up because they know how they generate capital in other areas. But the thing is that the consumer's dollar isn't as strong as it once was. With it being less liquidity in the economy, you got to understand this means that you don't have as much money that you want to spend. You have to be more mindful of where you're spending your dollar at as a consumer, is basically what that means. Okay, so you got to understand that people, if they might not want to be spending, if gas is more expensive, if rent is more expensive, if groceries are more expensive, if the cost of everyday living is more expensive, but your ability to earn money is the same because you haven't gotten a raise that was able to keep up with inflation or keep up with the fact that the interest rate has increased, which causes the cost of sales taxes are tied to that as well. They end up going up, so everything is went up, and but you haven't created more earning opportunity. So now guess what you have to do? Well, now I have less money to spend every month because everything else is going up. So now I have less money to discretionarily spend. So now you're going to see a drawback in that consumer spending. But when interest rates go down and now things in debt is a little less expensive, now you're going to see that influx go back. Well, now it's time to go to the movie theaters again. Now it's time to go to these restaurants again. Now it's time to go to these arcades and these Disneylands and things like these other experiences. Right now it's time to go do more as a consumer, have more, experience more, spend more, right? That's what it's all about. But now we got, as investors, right, we've already established that people are going to be putting on their consumer hats in an effort to consume as much as they can. Now we got to put on our investor hats to see where they're going to be focusing that consumer spending at, so we can make a buck off of it too. So like I said, automotives are going to do good. REITs will probably end up, well, REITs, you're still seeing higher prices on real estate, so you probably have to wait on that real quick. Commodities are going to fare fairly well. It's a few areas in the market that you want to be looking at. You want to be positioning yourself in order to figure out or achieve maximum result. Like you're gonna see, an increase in fintech. Fintech, I think, is gonna you're gonna get a boom with that, just because the financial space is gonna see they already have been benefiting from just the higher interest rate environment. But as debt becomes less expensive, you're gonna see more people taking out debt. So you're going to see more people utilizing these resources, utilizing these tools, these online digital tools and products to do a lot of their consuming with. So you're going to see a good surge in fintech. Of course, consumer staples will always be a good place to position your dollar. If you can find, like right now, the bio tech, right? Bio or pharmaceuticals are still a little bit beat up, like Pfizer's of the world, a little beat up. Of course, if anyone has their hand in on Ozempic or the weight loss drugs that are coming out, you can find great money over there. But you would have already wanted to have been invested in those areas of the markets, or it probably wouldn't have done you any good right now from an investor standpoint. Because you got to think about it. Even though I've given you a few areas of the markets to be invested in, right? And even though I gave you a few areas of the markets that you want to be positioned in, you got to think about it. At the end of the day, you still have to the goal is still to buy undervalued stocks, right? The goal is to still make sure that you're buying undervalued businesses that have the potential to still grow in value, right? The business still has room to grow, or the business is a steadily growing business, but the stock has plenty of room to grow, because the goal is to buy wonderful companies at great prices. That's the name of the game. Not average companies at great prices, right? Or wonderful prices. That's not how you want to play the games, as Charlie Munger so eloquently put it. But you have to learn where the money is to where the money is at. That way you can earn as much as you possibly can, right? Because you got to think about it. Your money is made when you buy, not when you sell. So if understanding that I need to buy low in order to increase my profitability, you have to be able to evaluate what an undervalued stock looks like. Because if you can't tell what an undervalued stock is, or if you can't tell what an amazing and wonderful business is, then you shouldn't be trying to play this game, right? Because if you're sitting here and you're looking to buy undervalued businesses, but you don't know what an undervalued business looks like, right? You don't know what a wonderful cash loaded business that's been growing 2 to 10% a year annually for the last 15 years looks like, or you don't know what an undervalued stock looks like, right? You're buying at 52-week highs and all-time highs. You're playing the game in reverse. You're hustling backwards at this point, because even though markets are pushing up, the goal is still to increase profits and maximize profits at the highest levels. The only way that can be achieved is if you buy low. You know, the only way you can achieve it is if you buy low. So if you're not buying low, if you're not sure if you're buying low, then I encourage you, join Stock Market Education Center. Contact me. I'm offering weekly coaching. I'm offering courses. I got a bundle I'm putting together right now that's going to give you the ability to find what undervalued stocks are, and then of course create opportunities for yourself to increase profitability from buying in a down market, right? Because it's always opportunities. I think it's always opportunities in the stock market for you to find undervalued companies. It's always undervalued companies everywhere in the stock market. It's over 4,000 stocks of companies that are publicly traded. You just haven't found the right one that's gonna 10x over the next 6 months to 6 years, right? You just haven't found the right one that's severely undervalued but has been growing. Like, you think Nvidia wasn't an amazing company before everyone found out that they were a powerhouse? Do you not think that it was money to be made in Apple before everyone made it an issue about having their products, or you got a green bubble versus a blue bubble? Did you think that it was an opportunity for increase and profitability in Amazon before everyone started getting everything shipped to their houses with those, you know, from buying packages from Amazon and having it shipped overnight, right? It's always been opportunities. You don't think Tesla was an amazing business before it became a status symbol to own a Tesla, or before they became you know, I'm gonna say a in-demand product, right? Or one of those products that's like, you know, if you got this, you're in the it crowd, right? Like, you gotta think about it. These companies have been amazing. Like Nvidia didn't just like decide it wanted to be an amazing company overnight. No, you just found out about it, and now you're trying to get in after the fact, right? Like, a lot of people that found out about Nvidia, the price was already $800 or $600. Like, you gotta think about it. They didn't go public that high, right? They haven't always been that. The price wasn't always that high. It built up until that point. You were just late to the party. So the name of the game is, as an investor, how can I be early? How can I be early when prices are low, when the company is still growing, when revenues are growing at 25% annually, earnings are increasing 10% year over year, market share is expanding, every single quarter. They're growing their international footprint. They're a multinational business now. They're deep in their pipeline. They're vertically and horizontally integrated to the point at which they're a juggernaut or a monopoly, but you don't know what that looks like because you haven't learned how to play the game yet. That's what this boils down to. When are you going to take investing seriously enough to where you can actually make a profit, right? Instead of it being, oh, who can tell me where the next hottest company is or the next amazing stock is, you got to learn how to play the game so you can position yourself as the economy shifts, as business cycles rotate, as sectors rotate, as money rotates and things like that. You got to be able to know where to position yourself for the next runway of growth. But if you never learn how to truly play this game or maximize on the opportunities that the stock market presents to you, you'll always be in last place. You'll always be chasing that next dollar. You'll always be chasing that hottest stock. You'll always be listening for the next thing that's supposed to make you rich, but you'll never achieve that goal because you'll always be behind. You're always chasing something instead of learning how to position yourself to where when the market flips and when the sectors rotate, you'll already be in position. You'll have already have built a wonderful, amazing position. You already own 100 plus shares, 1,000 plus shares, 10,000 plus shares of an amazing company that's set to 10x, 15, 20x and things like that over the course of the next 2 years, 3 years, 5 years, right? You're not buying the stock price today based on today's market value and price for it. Like you're gonna buy today because of the market price, but this price was already formulated and baked into this stock 2 to 5 years ago. So when you buy now, based on the current projections and based on the current ratios, you're buying based on what it's gonna do 2 to 10 years down the road. That's how you increase profitability. This is how you play the game. You're not doing it based on, oh, I think this is going to go up right now or in the next couple of months or whatever the case may be. You're doing this based on a long-term horizon. Okay, I know that the price that it is right now is baked into this stock already a couple of years back. This is what they were projecting it to be. It's here now. I know what it's projecting to be in the future. When it gets there, I'll be satisfied because I've held, guess what, over the long term, which is going to reduce my long-term capital. It's going to reduce my capital gain tax that I'm going to end up paying. Right? People are getting all hyped up about Warren Buffett selling stock right now in Apple and in Bank of America, not knowing that he's been holding Apple stock for almost 10 years now, and he's been holding Bank of America stock since probably the 90s or early 2000s. So you got to think about it. You're making you're what a time to lock in some profits when you're getting it at a reduced tax rate, and you're doing it when the prices are overvalued, when markets are overvalued, and you feel like prices are gonna come back down. Because typically, here's the thing: after you've gone into a period of of higher interest rate to get to that point of lower interest rate, you typically will hit, especially during presidential election years, you typically hit some turbulence in the markets, especially towards the end of the year. You tend to hit some turbulence in the markets during certain times. And if you're ready, if you have enough liquid cash to be able to capitalize when prices go to shit and when things go down, you will stand to earn more and profit more when things go back up, right? It's all about positioning. It's all about being in position and knowing where to position yourself. If you know where to position yourself, which is where the money is going to be being made at, right, over the course of the next year to 2 years, because you got to think about it. It was a lot of money that transferred hands over the last year and a half. If you've been investing, if you've been in the markets, if you've been keeping up with the flow of money, with the flow of investments, with the flow of different economic factors that lead to, profits, right? If you've been in tune with that, then you already know, like, you need to be prepared, you need to be ahead of the curve and of what's to come. And if you're not, you're playing a losing game, okay? So the message I want to leave everyone with is earnings are gonna tell you where you need to be positioning yourself right now. Like right now, Lululemon, a juggernaut of a business, had a very mixed earnings report, citing consumer weakness. They're letting you know that consumers are being more discretionary with their dollar. You know, Ulta Beauty, another juggernaut of a company, properly run business, don't carry too much debt, cash flow have been growing everywhere. If you look at Ulta Beauty, only in the nice areas, right? They have an upper echelon consumer based product, even though it's makeup and cosmetics, right? Like it's still not to say that there's not a pecking order of that. You know what I'm saying? So they had a pretty mixed earnings call this last quarter, citing more consumer weakness and things like that. So you just got to understand, like, if it's happening to the big boys, it's happening to everyone else. But we got to understand why it's happening. So if their stock price reflects that weaker guidance or their revised guidance to the downside, we know why. So we're not jumping ship. You got to think about it. Warren Buffett just bought up a bunch of shares of Ulta Beauty. Why? Because the business is undervalued. From the price that the stock is trading at right now relative to its book value. So what this means is, as long as based on their history of growth, the trajectory of growth is plenty of upside in the business fundamentally, as well as you will see that is going to reflect into the stock's price, which is going to be, of course, reflected in the money that you make in appreciation and capital gains. But you got to know where the money is flowing in order to dictate where your money is going, so you can get your money growing. All right, and I'm gonna keep saying it every time after time, man. I encourage anyone that's listening to this, share this video. Please, someone needs to hear a good word. Someone is in need of some investing education and wants to become a more intelligent investor, as do you, as do I. Continue to want to increase what I know, so I can increase the profits that I earn, right? And that's the name of the game. So join Stock Market Education Center. Be looking out for my next book that's going to drop, and it's going to be bundled with my dividend investing workbook. Be on the lookout for any new products or services. I do offer replays for my weekly coaching that I am doing right now. So please, I encourage you to ask me about my weekly coaching. Ask me about my previous coaching. I'm bundling it all together for you so you can have access to everything, so you can learn how to play this game from the top down. And I'm putting together some real good stuff. Until next time, investing family. Peace.